Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of how to manage concentration risk and protect your wealth. Diversification strategies. Diversification isn't just a buzzword, it's a fundamental practice for managing concentration risk. By spreading investments across sectors and assets, you reduce the odds that a slump in one area will wreck your financial plans. It's like having a backup plan for your backup plan. Spread across sectors. Don't let one industry dominate your portfolio. Think of it as mixing colors on a palette. Having more hues means a richer picture. Investing across different sectors such as healthcare, technology, and finance can provide a buffer against downturns in any single industry. Broaden asset types. Consider including stocks, bonds, real estate, and commodities in your portfolio. Diversifying asset types helps safeguard against the volatility of stocks or the low returns of bonds alone. Geographic expansion. Diversification isn't just about sectors, it's about geography too. Investing in various global markets minimizes the impact of local economic slowdown. It's like having friends in different countries. If one gets stormy weather, another might have sunshine. Consider mutual funds or ETFs. These allow you to invest in a plethora of sectors and regions with a single purchase. They work like a buffet, offering a bit of everything, ensuring you're not overexposed to one dish or another. Risk assessment and management tools. Navigating the waters of investment requires the right tools to steer clear of concentration risk. These frameworks are your compass and map, guiding you to safer shores. Portfolio risk analyzers. Tools like Portfolio Visualizer provide insights into how diversified your investments are. They break down your portfolio's exposure and offer scenarios to test its resilience. It's like having a weather app for your investments, predicting storms before they hit. Value at risk, VAR, models. These models calculate the potential loss in an investment portfolio over a specific period. It's like knowing how much rain you'll get before you plan a picnic. Understanding these metrics can help in making informed decisions about diversifying further. Monte Carlo simulations. A potent tool, Monte Carlo simulations model the probability of different outcomes. This analysis helps investors anticipate the impact of risks over time. Think of it as running various experiments in a lab to find the best suited potion for your portfolio. Stress testing. Regular stress tests determine how your portfolio would fare in extreme market conditions. Imagine simulating a roller coaster ride for your investments without the nausea. Knowing how they hold up can guide adjustments to avoid being too concentrated in any risk zone. Mitigating concentration risk involves thoughtful allocation and the right tools to guide your decisions. By taking these steps, you ensure your investments aren't just surviving but thriving, no matter the financial climate. Case studies of concentration risk failure. In the world of finance, concentration risk can signal trouble. Ignoring or underestimating this risk has led to some of the most notable financial downfalls in history. When investments are too heavily concentrated, the groundwork becomes shaky. Understanding past failures not only helps investors learn valuable lessons but also reinforces the importance of diversification strategies. Let's explore some real-world examples where concentration risk played a critical role in financial meltdowns. Financial crises and concentration risk. History shows that financial crises often have roots in concentration risk. By examining these cases, we can see how vulnerable financial systems become when too much weight is placed on a limited number of assets or sectors. During the 2008 financial crisis, a major factor was the over-reliance on mortgage-backed securities and related financial products. Banks and financial institutions heavily invested in real estate, with the assumption that housing prices would continue to rise. This assumption proved disastrous when the housing bubble burst. It was like betting everything on one horse in a race that suddenly took a sharp turn. The collapse of Lehman Brothers is often cited as a pivotal moment, highlighting the dangers of unchecked concentration in a specific financial product. Another stark example is the Asian financial crisis of 1997. Many Asian economies, particularly Thailand, had large amounts of foreign debt and were highly dependent on real estate and exports. The concentration of investments in these areas created a domino effect when speculative attacks on the Thai baht caused currency devaluations across the region. As currencies fell, the over-reliance on short-term debt and narrow economic bases became painfully clear, resulting in sharp economic downturns. Corporate failures due to concentration risk. It's not just financial sectors that suffer from concentration risk, corporations can too. Sometimes, putting too many chips on one product, client, or market can spell disaster for big businesses. Take the example of Nokia, once a titan in the mobile phone industry. During the late 2000s, they focused heavily on their existing mobile technology without adapting to the surge of smartphones and new software ecosystems. Nokia's overemphasis on hardware and slow adaptation to the software revolution led to a significant decline, almost like a giant toppling over because it refused to move with the times. Similarly, Kodak offers a cautionary tale. This company dominated the photographic film market for decades but failed to diversify its investments into digital technology when the industry shifted. Kodak's concentration on film, despite having invented a digital camera in the 1970s, meant they were starkly unprepared when digital photography became prevalent. Their reluctance to adapt serves as a reminder that even giants can be brought down by the inertia of concentration risk. These stories serve as stark reminders. Neglecting concentration risk can have serious implications. For both financial institutions and corporations, the failure to diversify can lead to a swift downfall. Understanding these cautionary tales helps investors and companies safeguard against similar fates, underscoring the necessity of keeping a wide-angle lens on their economic strategies. Regulatory perspectives on concentration risk. Understanding how regulators view concentration risk is crucial for anyone involved in finance. These are the frameworks that help prevent economic disasters. Regulators aim to keep financial systems stable by addressing the risks of too much reliance on a single investment or sector. Let's look at two major pieces of regulation that tackle this issue. Basel Accords and concentration risk. Basel III is a set of international banking regulations developed by the Basel Committee on Banking Supervision. It aims to strengthen regulation, supervision, and risk management within the banking industry. So, what does it do about concentration risk? Stricter capital requirements. Basel III mandates banks to hold more capital against their assets, making them more resilient to potential losses from concentrated exposures. Leverage ratios. These ensure banks don't overextend themselves by borrowing too much, which can increase concentration risk. It's like making sure a tightrope walker has a safety net in place. Liquidity coverage ratios. Banks need enough liquid assets to cover potential large-scale withdrawals. A concentrated set of illiquid assets could spell trouble in a crisis. Basel III recognizes that concentration risk isn't just about holding diverse assets. It's also about having enough resources to absorb shocks when things don't go as planned. Dodd-Frank Act considerations. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in response to the 2008 financial crisis, seeks to reduce systemic risks and prevent future bailouts. Here's how it impacts concentration risk. Volcker Rule. This limits banks from engaging in proprietary trading and from owning or investing in hedge funds or private equity, reducing exposure to risky, concentrated bets that could destabilize the institution. Stress tests. Regular testing of banks' financial health ensures they can withstand economic turndowns without collapsing under concentrated risks. It's much like running a fire drill to ensure safety systems are ready in an emergency. Increased transparency. By demanding more disclosure from financial institutions, Dodd-Frank allows for better monitoring of potential concentration risks, making it harder for dangerous accumulations of risk to go unnoticed. With these measures, the Dodd-Frank Act aims to make sure financial institutions spread their investments wisely, much like planting a diverse garden to ensure seasonal yields. Both Basel III and Dodd-Frank highlight the importance of diversified investments to maintain the stability and health of financial systems. They're like a financial GPS, keeping banks on the right track and away from the dangers of too much concentration. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.